Introduction: An ordinary man, a Wall Street legend. In the volatile world of finance, where tens of millions pursue freedom, wealth, and significance, only a rare few leave a mark that echoes through time. Richard Dennis was one of them. He didn't attend an Ivy League university. He didn't inherit privilege or capital. He began with $1,600, borrowed from his family, and stepped onto the roaring trading floors of Chicago in the early 1970s. Within less than a decade, he transformed that small loan into more than $200 million. But it wasn't the fortune that earned him legendary status. It was the philosophy he lived by. That great traders are not born, they are built. That trading isn't a talent, it's a process, a mindset, a system. And if taught correctly, almost anyone could master it. To prove his conviction, Dennis launched one of the boldest social financial experiments in Wall Street history, the TurtleTraders. He recruited a handful of ordinary people, teachers, engineers, a security guard, a pianist, and trained them for exactly 2 weeks. Then he handed them real capital, millions of dollars, and instructed them to follow a rules-based system grounded in trend following. The results were staggering. These so-called turtles generated tens of millions of dollars in returns. Some became trading legends in their own right. But even more important than their profits was the proof. Discipline beats intuition. Rules beat emotion. Systems beat instincts. This book is a curated synthesis of 4 timeless works: The Complete Turtle Trader, Market Wizards, Trend Following, and Way of the Turtle. It blends biography, strategy, and psychology into one cohesive journey through the life, mind, and legacy of Richard Dennis. Because Dennis didn't just trade markets, he reshaped how we understand them. You don't need to predict, you need to follow. You don't need genius, you need patience. You don't need to be extraordinary, you need to be consistent. Welcome to the story of how a man turned $1,600 into $200 million. Not by luck, not by genius, but by mastering the art of trend, the science of discipline, and the courage to follow the system. Chapter 1: From Floor Runner to Millionaire. Richard Dennis wasn't supposed to win. Born on the south side of Chicago in the early 1940s, he grew up in a working-class Irish Catholic family where money was tight and ambition was tempered by realism. His first taste of the markets came not from a lecture hall at Harvard, but from the noisy pits of the Chicago Mercantile Exchange, where he worked as a runner, barely a teenager, earning $60 a week. His job was simple: relay paper orders between brokers. But as he weaved through the chaos, he watched. He listened. He absorbed the rhythm of the market like a musician learning a new language. And something inside him began to burn, not just curiosity, but conviction. He didn't want to carry orders. He wanted to place them. At the age of 17, Dennis scraped together $400, his entire savings, and began trading from a small account his father helped him open. He lost nearly all of it within days. Most would have walked away. Dennis doubled down. By the early 1970s, he had borrowed $1,600 from his family and leased a seat on the Mid-America Commodity Exchange, one of the smallest and cheapest in Chicago. There, he began trading futures contracts, starting with soybeans and grains. It wasn't glamorous. The contracts were small, and the stakes were modest. But the lessons? Immense. Dennis developed a reputation quickly, not just for making money, but for how he made it. He wasn't a gambler. He didn't scream across the pit or chase wild hunches. He watched trends. He followed patterns. He placed trades that looked almost boring until they weren't. His method? Ride the wave. I always say you could publish my rules in the newspaper and no one would follow them. The key is consistency and discipline. Richard Dennis. In less than 10 years, he turned $1,600 into more than $200 million, not with secret indicators, not with insider information, but with a repeatable system, iron discipline, and unshakable belief in probabilities over predictions. Wall Street began to whisper. Then it began to shout. Who was this young man with the monk-like demeanor and the mathematical mind? How was he winning trades others wouldn't dare to enter? Dennis didn't just build wealth, he built credibility. And behind closed doors, he began formulating a new question, one that would soon redefine his legacy. If I can do it, can others? Can trading be taught like engineering, music, or chess? The answer would become one of the boldest experiments in modern financial history. But first, the world had to understand something essential. Richard Dennis wasn't just trading markets, he was rewriting the rules of who gets to win. Chapter 2, Faith in the System. Not Wall Street loves a myth. The lone genius, the sixth sense, the trader who just knows when to buy and when to sell. But Richard Dennis wasn't interested in myth. He was interested in math. To him, the idea that success came from gut instinct was not only misleading, it was dangerous, because instinct by nature is erratic, emotional, unreliable. And in the high-stakes world of commodities, one emotional decision can cost you everything. Dennis believed something radically different. Great trading isn't born in the gut, it's built in the system. He didn't chase news headlines or whisper trades. He didn't rely on economic forecasts or CNBC commentary. Instead, he followed a set of rules, clear, mechanical, unemotional. His philosophy was simple but powerful. Price is the truth. Trends are real. Follow them. It sounds almost too simple, but that's the point. The market doesn't care what you think. It doesn't reward your opinion. It rewards your discipline. He knew the human brain was wired for sabotage. Traders panic when markets fall. They get greedy when prices rise. They exit too early or too late. They seek comfort instead of clarity. That's why Dennis removed emotion entirely from the process. His trades weren't based on predictions. They were based on price action. If the market broke out above a defined level, he entered. If it reversed and hit a stop, he exited. No second guessing, no hesitation, no maybe. The core idea, let the system decide. Dennis's system wasn't magical, it was mathematical. He used breakout strategies, risk-defined position sizing, trailing stops, and strict rules for every entry and exit. The edge wasn't the algorithm, it was the execution, over and over, without fail. This wasn't just philosophy, it was tested. He made millions applying it. Then he handed it to others, novices really, and watched as they too generated wealth following the same blueprint. The lesson? It's not who you are, it's what you follow. Why most traders fail? Most traders lose not because their ideas are bad, but because their behavior is. They abandon systems after a few losing trades. They override signals based on emotion. They think they're smarter than the market. And above all, they confuse luck with skill. Dennis didn't. He knew even the best system would lose sometimes. He welcomed drawdowns. He expected streaks. But over the long arc of time, his system delivered. And that's all that mattered. Discipline. The hidden alpha. Every institution preaches strategy. Few teach discipline. But Dennis understood. The real edge isn't in the setup. It's in sticking to it. Most traders are system hoppers, jumping from one method to another like gamblers switching tables. Dennis was a system master. He found a method that worked, and he committed to it through droughts, storms, and doubts. And it's here where legends are separated from dreamers. A good system with discipline will outperform a great system without it. Coming up next, the turtle experiment. When Dennis set out to prove that trading could be taught, he didn't just write a manual. He put his money and his legacy on the line. What happened next would shake the foundations of trading forever. Chapter 3, The Turtle Experiment, Creating Millionaire Traders from Scratch. In the winter of 1983, inside a nondescript Chicago office, Richard Dennis prepared to make history, not with a trade, but with a test. A bold, almost outrageous hypothesis. Trading can be taught. To most professionals on Wall Street, this was heresy. Trading, they believed, was an art, an instinct, a gift, something you either had or didn't. Dennis disagreed, and he was ready to prove it. What followed became one of the most legendary experiments in financial history. The bet that changed trading forever. It started with a debate between Dennis and his longtime friend and partner, William Eckhart. Dennis believed that anyone, with the right training and rules, could become a successful trader. Eckhart, a mathematician, was skeptical. He argued that true trading success depended more on psychological makeup than method. Discipline couldn't be taught, he said, nor could patience or emotional resilience. Dennis disagreed and proposed a test. They would take complete novices, teach them Dennis's trend-following system, and then fund their trades with real money. This wasn't theory, it was implementation at scale. Finding the turtles. To recruit candidates, Dennis placed ads in major newspapers, including the Wall Street Journal and Barron's. The ad read, "Richard Dennis is accepting applications for a group of individuals to train in his proprietary trading techniques. Prior experience is not necessary." Thousands applied. Dennis and Eckhart whittled the pool down to just over a dozen. The final class came from all walks of life: an accountant, a blackjack player, a security guard, a software developer. None of them had any professional trading experience. Dennis called them the Turtles, a name inspired by turtle farms he had visited in Singapore. The idea? Traders, like turtles, could be bred in captivity. 2 weeks, one system. Dennis trained the turtles for just 2 weeks. During that time, he taught them how to identify breakouts, how to size positions based on market volatility, how to set stops and take profits, how to manage risk religiously, how to follow trends without questioning them. No opinions, no forecasts, just rules. Every turtle received a written manual, hundreds of pages of rules, charts, and exact instructions. They didn't just memorize the system, they practiced it. And once Dennis was confident in their understanding, he gave each of them real money to manage. Some turtles started with $1 million in capital. Others began smaller, but the results were stunning. Hash the results. Within 4 years, the turtle traders had made over $175 million in profits. Several became multimillionaires. Some launched their own funds. Many went on to become legends in their own right. The system worked, not because it was magical, but because it was executable. It removed emotion, emphasized discipline, and leveraged the power of long-term trends. Most importantly, it validated Dennis's belief: trading success could be taught. The core of the turtle strategy. At its heart, the turtle method was trend following, but it wasn't simplistic. It combined breakout entries, buying when prices broke above a defined range, volatility-based position sizing, using the average true range ATR to determine how much to risk, trailing stops, exiting only when the trend had clearly reversed, diversification, spreading risk across multiple markets, commodities, currencies, interest rates, and more. Everything was rule-based. Turtles were not allowed to override the system, even if they felt a trade was wrong. This was the ultimate test of discipline. The key to trading success is emotional discipline. If intelligence were the key, there would be a lot more people making money trading. Lessons beyond trading. The turtle experiment was about more than just money. It was about mindset. It proved that behavior beats brilliance. Systems beat opinions. Discipline beats emotion. In a world obsessed with complexity, Dennis showed that simplicity, executed consistently, could generate extraordinary results. The myth of the lone genius trader began to crumble. In its place, a new model emerged: the rule-based, process-driven investor. The modern legacy. Decades later, the turtle legacy remains powerful. Books have been written, funds have been launched, the principles have been adapted to everything from crypto to quantitative hedge funds. Yet the core truth endures. You don't need a PhD, insider connections, or a Wall Street pedigree to win in markets. What you need is a process, a plan, and the discipline to follow it relentlessly. In a world chasing magic, Richard Dennis bet on mechanics, and he won. Chapter 4: The Rules of the Turtle System. Discipline in action. The success of the turtle experiment wasn't a matter of luck or intuition. It was the direct result of rules, clear, precise, and uncompromising. Richard Dennis didn't just teach his students to trade, he gave them a blueprint, a system that took the guesswork out of trading and replaced it with consistency. Understanding these rules is key to unlocking the secret of the turtles' extraordinary success. These were the lifeblood of their trading, the guardrails that kept emotion and impulsiveness at bay. Rule 1: identify the trend with breakouts. At the core of the turtle system was the concept of breakouts. A breakout happens when price moves beyond a specific range, a signal that a new trend might be starting. Dennis taught the turtles to watch for 2 primary breakout signals. 20-day breakouts, a shorter-term signal indicating an emerging trend. 55-day breakouts, a longer-term confirmation indicating a more established trend. When the price closed above the high of the past 20 days or 55 days, the turtles would enter a buy position. If the price broke below the low of those ranges, they would enter a short position. This dual breakout system allowed them to capture trends early, but also to confirm them with longer-term data. Rule 2. Position sizing, based on volatility. One of the genius elements of the turtle rules was their use of volatility to size positions. Dennis understood that markets aren't static. Some days are calm, others stormy. To manage risk effectively, turtles calculated the average true range ATR, a measure of how much price typically moves in a day. The higher the ATR, the more volatile the market. Position size was inversely proportional to volatility. In highly volatile markets, they took smaller positions to limit risk. In calm markets, they took larger positions. This approach balanced risk across all trades, preventing any single position from overwhelming the portfolio. Rule 3. Risk no more than 1% per trade. Discipline in risk management was drilled into the turtles. They were instructed to never risk more than 1% of their total trading capital on any single trade. For example, if a turtle was managing $1 million, the maximum loss they could accept per trade was $10,000. This limit was enforced strictly with stop-loss orders. Automatic sell or buy orders would exit a trade if the price moved unfavorably by a predefined amount. Rule 4. Use of stop-losses and trailing stops. Stop-losses weren't just a defensive tactic, they were a critical part of the system's profitability. The turtles set initial stop-losses based on the volatility, ATR. This meant their stops were dynamic, moving with market conditions. Once a trade was profitable, they used trailing stops, adjusting the stop price as the market moved in their favor, locking in gains while allowing room for the trend to develop. This disciplined exit strategy ensured winners ran their course, while losers were cut quickly before losses ballooned. Rule 5. Diversification across markets. Dennis taught the turtles to trade across a variety of markets, not just stocks, but commodities, currencies, bonds, and interest rates. This diversification was crucial. It meant that when one market was flat or losing, others might be trending and generating profits. It also reduced portfolio risk by avoiding concentration in a single asset or sector. Rule 6. Limit the number of units per market. To prevent overexposure, turtles were limited in the number of units they could hold in any single market. A unit was a predefined size based on volatility-adjusted calculations. Turtles could add units as trends continued, but only up to a maximum, ensuring no single position dominated. Rule 7. Follow the rules, not your gut. Perhaps the most important rule was the unyielding adherence to the system itself. Turtles were taught to suppress emotions and ignore instincts that contradicted the rules. If the system said to enter a trade, they entered. If it said to exit, they exited. No second guessing. This level of discipline is rare, but it's what made the system reproducible and scalable. The philosophy behind the rules. At first glance, the turtle rules might seem rigid, even mechanical. But beneath the surface lay a profound understanding of human psychology and market behavior. Dennis recognized that many traders failed because of emotional biases, fear, greed, hope, that clouded judgment. By codifying the trading process into strict, unemotional rules, he removed those biases. The rules created a framework where losses were controlled and accepted as part of the process. Winners were allowed to run, maximizing gains. Decisions were consistent, reducing mental fatigue and hesitation. Why these rules still matter today. Though markets have evolved dramatically since the 1980s, the principles behind the turtle system remain relevant. Automated trading, machine learning, and quantitative strategies dominate today's landscape. But at their core, many still use principles akin to trend following and risk management pioneered by Dennis. For aspiring traders, the turtle rules offer a timeless lesson. Success isn't about predicting the market perfectly, but about managing risk and following a plan. Common misconceptions and challenges. Trend following is too slow. While some trades may take weeks or months to develop, the system's power lies in compounding small wins over time. It's a marathon, not a sprint. Rules kill creativity. In trading, creativity without discipline often leads to chaos. The turtle system shows that structure enables freedom from emotional mistakes. Stop losses guarantee losses. Properly used, stops limit damage. Without them, traders risk catastrophic losses. Final thoughts. The power of process. Richard Dennis's turtle experiment proved one crucial truth. Success in trading comes from a process, not a personality. The turtle rules codified that process. They stripped away ego and emotion, replaced guesswork with data, and transformed trading from an art of chance into a science of probability. For any trader willing to embrace discipline, the turtle system offers a blueprint, not just for trading, but for decision-making in any high-stakes arena. Chapter 5, Lessons from the Turtles. Wisdom from the Front Lines. The story of the turtle traders is not just a tale of a successful experiment. It is a treasure trove of timeless lessons about trading, risk, psychology, and the path to consistent profitability. The turtles came from all walks of life: students, truck drivers, engineers, and others with no prior trading experience. Yet, under Richard Dennis's guidance, they mastered a system that generated millions of dollars in profits. Their journey offers invaluable insights that every trader, investor, or decision maker can learn from. Lesson 1. Trading is a skill that can be taught. The prevailing myth before Dennis's experiment was that successful trading was an innate talent, a secret gift possessed by a fortunate few. Dennis shattered this myth by demonstrating that trading is a skill, not magic. Given the right tools, education, and discipline, virtually anyone can learn to trade profitably. This lesson changed the mindset of traders worldwide, turning trading from an elusive art into a teachable craft. Lesson 2. Discipline outweighs intelligence. Intelligence alone does not guarantee success in trading. Many brilliant minds have failed because they lack discipline. The turtles succeeded because they followed their rules strictly, even when it was uncomfortable. They cut losses quickly, stuck to their position sizes, and resisted the temptation to chase the market. Discipline is the bridge between knowledge and profit. Lesson 3. Risk management is paramount. No strategy, no matter how brilliant, can survive without proper risk management. The turtles never risked more than 1% of their capital on any trade. This simple rule protected them from catastrophic losses and allowed them to stay in the game through inevitable losing streaks. Managing risk is the foundation upon which consistent profitability is built. Lesson 4. Let profits run. Cut losses short. One of the most powerful concepts the turtles embraced was to let winners run and cut losers quickly. Markets tend to trend over time, and capturing those trends is where most profits come from. Meanwhile, losses can and should be limited early before they snowball. This lesson is hard to implement because it goes against human nature. People often hold losing trades hoping they will turn around. The turtle system enforced this discipline with trailing stops and strict exit rules. Lesson 5. The market is always right. Successful traders accept the market's movements without judgment. When the market moves against a trade, it doesn't mean you are wrong in a personal sense. It simply means the market is signaling a change. The turtles learned to accept losses as the cost of doing business and to focus on the next opportunity. This mindset of humility and acceptance prevents emotional trading and burnout. Lesson 6. Consistency beats heroics. Trying to beat the market with clever, high-risk bets is a recipe for disaster. The turtle system focused on consistency, small, disciplined trades repeated over time. Consistency reduces risk and increases the likelihood of long-term success. It's better to make a series of steady gains than a single big win followed by ruin. Lesson 7. Emotional control is a competitive edge. Markets can be volatile, and it's easy to get swept away by fear or greed. The turtles' greatest strength was their ability to control emotions. They followed their system no matter what, ignoring market noise and personal biases. Emotional control is often the deciding factor between profitable traders and those who lose everything. Lesson 8. Adaptability within a framework. While the turtle rules were strict, they weren't rigid in a way that ignored market evolution. Successful turtles learned to adapt to changing market conditions while maintaining the core principles. This balance between structure and flexibility is essential for survival in dynamic markets. Lesson 9. Simplicity works. The turtle system's elegance lay in its simplicity. Complex indicators and convoluted strategies were replaced by clear rules based on price and volatility. This simplicity made the system easy to follow and reduced errors. Simplicity is often overlooked in trading, but it's one of the most effective ways to stay consistent. Lesson 10. Education and mentorship matter. Richard Dennis's role as a mentor was crucial. He didn't just hand over a system, he taught the turtles how to think about risk, discipline, and markets. Continuous learning and mentorship can accelerate growth and prevent costly mistakes. Real stories from the turtles. Jerry Parker, one of the original turtles, attributes his success to strict adherence to the rules even during tough times. When emotions were high, I reminded myself that the system was built to handle losses. Trusting the process kept me in the game. Curtis Faith, another turtle, emphasizes the importance of risk management. No single trade should ever wipe you out. That was drilled into us day one. These stories reflect the core lessons and demonstrate that success is as much about mindset as it is about strategy. Practical takeaways for traders today. Build a clear, tested system. Don't trade based on hunches or rumors. Control your risk strictly. Know your maximum acceptable loss before entering a trade. Stick to your plan even when it's tough. Discipline wins over time. Accept losses without ego. Every trader loses. The key is to minimize damage. Keep learning. Markets evolve, and so should your approach. Conclusion: more than just trading. The TurtleTrader's journey was more than a trading experiment. It was a lesson in human behavior, resilience, and the power of systems. Their success shows that greatness in trading comes not from luck or brilliance alone, but from consistent, disciplined application of sound principles. For anyone willing to learn and stay disciplined, the Turtle Legacy offers a roadmap to success, not just in markets. Chapter 6. Trend Following, the Timeless Philosophy. In the chaotic world of financial markets, where noise, speculation, and emotions dominate daily trading activity, one principle has endured through centuries: trend following. It is a philosophy that transcends styles, asset classes, and market conditions, standing as a beacon of clarity and consistency for traders and investors alike. Richard Dennis, through his turtle experiment, demonstrated that trend following is not just a strategy. It is an art and science grounded in market behavior, psychology, and disciplined execution. The essence of trend following. At its core, trend following is straightforward. Buy what is going up, sell or short what is going down. This simple mantra may sound trivial, but its implementation demands patience, discipline, and an understanding that markets move in waves, not straight lines. Markets have a natural tendency to trend over time, driven by fundamental forces like economic growth, technological innovation, or shifts in supply and demand. These trends can last days, weeks, months, or even years. The trend follower's job is to identify these movements early, ride them as long as possible, and exit before the momentum fades. Why trend following works? 1. Markets are not efficient at every moment. While the efficient market hypothesis claims that prices always reflect all available information, reality is messier. Markets are influenced by human emotions, fear, greed, herd mentality, which create inefficiencies. Trend following exploits these inefficiencies by riding momentum created when enough participants start buying or selling. 2. The power of behavioral finance. Human behavior is predictable in many ways. When prices rise, more traders jump on board due to fear of missing out, FOMO, pushing prices even higher. Conversely, panic selling can create downward trends. Trend followers leverage these psychological biases, aligning themselves with the market's dominant sentiment rather than fighting it. Number 3, risk management amplifies profit potential. By strictly managing risk, using stop losses and position sizing, trend followers can stay in trades through volatility and avoid devastating losses. The asymmetry of trend following lies in letting profits run while keeping losses small. Winning trades can be several multiples larger than losing trades, creating an edge over time. The turtle traders and trend following Richard Dennis's turtle system was built entirely on trend following principles. The rules he taught his students involved buying breakouts above recent highs and selling short below recent lows. They used technical indicators like moving averages and average true range, ATR, to measure volatility and adjust position sizes accordingly. This systematic approach removed emotional decision-making, allowing the turtles to capture large market moves consistently. The discipline behind trend following. Trend following is deceptively simple but psychologically challenging. It requires patience, waiting for clear signals rather than forcing trades; conviction, staying in a trade even during short-term pullbacks; detachment, accepting losses when a trend reverses without hesitation. Many traders fail because they enter trades too early or exit too late, driven by hope or fear. The turtle philosophy teaches that the market will always have noise, but the trend is your friend until it ends. Common misconceptions. Trend following is only for long-term investors. While some trends span years, trend following can be applied to short and medium-term timeframes as well. Trend following ignores fundamentals. Trends are often the result of underlying fundamental shifts. Trend followers simply respond to price action. It's a get-rich-quick scheme. Successful trend following requires rigorous discipline, risk control, and the acceptance that losses are part of the game. Modern applications of trend following. In today's diverse markets, from stocks and commodities to cryptocurrencies and forex, trend following remains relevant. Quantitative hedge funds, CTA, commodity trading advisors, and retail traders employ trend following systems enhanced by technology and data analytics. Algorithmic trading platforms execute trend following strategies faster and more precisely than ever before. Yet, despite technological advances, the foundational principles remain unchanged. The psychological edge. Trend following aligns the trader's mindset with the natural rhythm of the markets. It encourages humility, acknowledging that no one can predict tops or bottoms with certainty, and promotes adaptability. By following the trend, traders avoid the costly trap of fighting the market and instead become part of the broader market consensus. Putting trend following into practice. 1. Identify the trend. Use price breakouts, moving averages, or momentum indicators to confirm a trend. 2. Manage risk. Determine position size based on volatility and set stop losses to limit downside. 3. Ride the trend. Hold positions while the trend remains intact, adjusting stops to lock in profits. 4. Exit gracefully. When the trend reverses or signals weaken, exit quickly to preserve capital. The timelessness of trend following. What makes trend following truly timeless is its foundation in universal market truths and human behavior. It does not rely on predicting the future, but reacts to what the market is telling us right now. Richard Dennis's legacy, and that of the Turtles, proves that adherence to this philosophy, combined with discipline and risk management, can create sustained success in trading. Final thought. Trend following is more than a trading style. It is a mindset, a philosophy of humility, patience, and respect for the market's natural order. For traders seeking a proven path through the chaos, embracing trend following offers a roadmap to navigate uncertainty and harness the market's momentum for long-term success. Chapter 7. Discipline, the survival key. In the realm of trading and investing, discipline is often cited as the single most important factor separating consistent winners from those who struggle or fail. It is the backbone of every successful trader's journey, yet paradoxically, the hardest virtue to master. Richard Dennis understood this deeply. His legendary turtle traders weren't just taught rules, they were rigorously trained to embody discipline above all else. Because without discipline, even the most brilliant trading system is doomed to fail. Why discipline matters more than strategy. No matter how sound or tested a trading strategy might be, it can only produce profits if executed with unwavering discipline. Here's why. Markets are unpredictable and volatile. Even the best setups sometimes fail. Emotional control keeps traders from abandoning their plans prematurely or doubling down recklessly. Losses are inevitable. Discipline ensures losses are kept small and controlled, preventing ruinous blowups. Consistency beats brilliance. A mediocre strategy executed with discipline outperforms a brilliant strategy executed haphazardly. Discipline, the bridge between knowledge and success. Richard Dennis's turtle experiment was, at its core, a test of whether ordinary people could be taught to trade successfully by following a simple, disciplined system. The answer was a resounding yes. What Dennis proved was that discipline can be taught and learned, transforming novices into profitable traders who stuck to the rules no matter what. Components of trading discipline. 1. Following the rules, no exceptions. The turtles were instructed to never deviate from their trading system. No gut feelings, no improvisation, just rigid adherence. 2. Managing risk relentlessly. Position sizing, stop losses, and risk limits were non-negotiable. Discipline meant accepting small losses to protect capital. 3. Emotional control. Fear, greed, hope, and regret are the trader's greatest enemies. Discipline requires mastering these emotions, maintaining calm through winning streaks and losing streaks alike. 4. Patience and timing. Waiting for the right setups and signals rather than chasing the market. Discipline is about resisting impulsive trades. The discipline challenge: psychology versus logic. Humans are wired to seek immediate gratification and avoid pain. This biological wiring makes trading discipline difficult because the market constantly triggers emotional responses. Fear of missing out tempts traders to jump in too early. Loss aversion makes it hard to take small losses, leading to bigger ones. Overconfidence after wins can prompt reckless risk-taking. Richard Dennis's approach was to replace these instinctual reactions with mechanical rules, rules that the brain could rely on even when emotions ran high. Discipline in practice. Lessons from the turtles. The turtles had clear rules for entries and exits, position sizing, and risk limits. They maintained trading journals to track performance and emotions. When faced with losses, they didn't chase or revenge trade. They stuck to the system. They respected the market, accepting that losses are part of the journey. Building your discipline. Like any skill, discipline improves with deliberate practice. Set clear rules and stick to them. Use checklists before executing trades. Keep a trading journal to review decisions and emotions. Develop routines to maintain focus and calm. Learn to accept losses quickly and unemotionally. Discipline protects capital, your most valuable asset. In trading, capital preservation is paramount. Without discipline, losses can compound rapidly, wiping out accounts and confidence. Discipline is the guardian of your capital, ensuring you stay in the game long enough to capitalize on profitable opportunities. The paradox of discipline: freedom through structure. Though discipline may sound restrictive, it actually provides freedom. The freedom to trade without fear, second-guessing, or chaos. By creating boundaries through rules and habits, discipline empowers traders to act decisively and consistently. Discipline as a way of life. For Richard Dennis and the Turtles, discipline extended beyond trading. It became a mindset applicable to all areas of life: business, relationships, and personal growth. This holistic approach is why the turtle system transcends markets and remains relevant decades later. Final thought: discipline is the survival key in trading. It transforms strategies into profits, emotions into control, and chaos into order. Without discipline, even the best trader is vulnerable. With it, even an average trader can thrive. Embrace discipline not as a burden, but as your greatest asset on the road to trading mastery. Chapter 8: Mistakes and Failures of Richard Dennis. Every legend's journey is marked not only by triumphs, but also by failures. Richard Dennis, despite his extraordinary success, was no exception. Understanding his mistakes is as valuable as studying his wins because it reveals the human side of a trading titan and offers timeless lessons on resilience and adaptation. The myth of the flawless trader. The financial world often glamorizes great traders as infallible geniuses. However, Dennis's story reminds us that even the most brilliant minds are vulnerable to errors, overconfidence, and unforeseen market shifts. Mistakes are inevitable in trading. What matters is how you respond. Over-leverage and risk mismanagement. One of Dennis's critical challenges was over-leveraging. In the pursuit of larger gains, he occasionally took on risks that exposed him to massive drawdowns. In the early years, buoyed by his winning streaks, Dennis increased position sizes aggressively. This exposed him to catastrophic losses during unexpected market reversals. It highlighted that no strategy is immune to risk without proper controls. This lesson reinforced the TurtleTrader's emphasis on strict risk management and position sizing to safeguard capital. Overconfidence after success. Dennis's early, rapid wealth fueled a natural but dangerous tendency toward overconfidence. Success can blind traders to potential pitfalls. overconfidence often led Dennis to deviate from his system, relying more on intuition than rules. Such behavior opened the door to inconsistent results. This underscores the critical importance of humility and respect for the markets. Market conditions change. Systems must evolve. Dennis's original turtle system thrived in trending markets, but faced challenges when markets shifted to choppier, range-bound conditions. Sticking rigidly to trend-following rules during these phases caused underperformance. Dennis learned that no single system works forever. Adaptability is essential. This insight is vital for every trader. Systems must evolve with changing market dynamics. Emotional battles and stress trading at high stakes brings intense psychological pressure. Dennis openly acknowledged moments of self-doubt and emotional turmoil. Even with rules and discipline, human emotions occasionally interfered with decision-making. Recognizing this human vulnerability helped him develop better mental frameworks and stress management techniques. Learning from failure, the foundation of growth. Dennis's mistakes did not mark the end of his journey. They were stepping stones to greater wisdom. He used failures as critical feedback, refining his strategies and mindset. His turtle experiment itself was partly motivated by a desire to prove that discipline and systems could overcome human flaws. Dennis's story teaches that failure is an inevitable part of trading growth. Embrace it, learn from it, and move forward stronger. The greatest failure: underestimating risk culture. Perhaps Dennis's most profound lesson was in appreciating the culture of risk. Early on, he underestimated how psychological factors could erode even a sound trading system. He realized that fostering a disciplined mindset was as important as building mechanical rules. The Turtle program's success lay in cultivating a culture where discipline and risk awareness were ingrained values. Legacy through imperfection. Richard Dennis's legacy is not perfection, but perseverance through imperfection. His openness about mistakes humanizes the myth, making his success accessible to anyone willing to commit, learn, and adapt. Final thought. Mistakes and failures are not stains on a trader's record. They are the ink in the story of mastery. Richard Dennis's journey exemplifies that. Embracing failure with discipline and humility transforms setbacks into springboards for success. The path of a trader is a marathon, not a sprint. Learn from mistakes, adapt relentlessly, and maintain unwavering respect for the markets. Chapter 9: Legacy and Global Influence. Richard Dennis's story transcends personal success. It is a legacy that reshaped trading philosophy and continues to influence markets worldwide. His journey from a humble runner to a legendary trader forged a path that countless traders and investors still follow today. The birth of a new trading paradigm. Dennis's greatest contribution lies not just in his profits, but in pioneering a systematic, rules-based approach to trading. He challenged the notion that trading success was the domain of insiders with intuition or secret knowledge. By proving that anyone could be taught to trade successfully through discipline and systems, Dennis democratized trading. This paradigm shift empowered retail traders and institutional investors alike to adopt quantitative and mechanical strategies. The enduring influence of the turtle traders. The turtle traders experiment remains a benchmark in trading history. It showed that structured education and clear rules can produce consistent profitability. Many former turtles became successful traders and educators, spreading Dennis's methods globally. Their stories continue to inspire a new generation of trend followers, risk managers, and system traders. Trend following as a global phenomenon. Dennis's core philosophy, trend following, has grown into a dominant strategy embraced worldwide. From hedge funds to family offices, the principles of riding market trends and strict risk control are now mainstream. Legendary investors like Ed Seykota, John W. Henry, and others expanded on Dennis's work, creating multi-billion-dollar funds based on similar models. Trend following proved its resilience through decades of market cycles, crises, and technological change. The impact on modern quantitative trading. Dennis's approach laid foundational stones for quantitative trading and algorithmic strategies. His emphasis on rule-based trading anticipated the rise of computerized models. The turtles' documented rules are often studied and adapted in today's algorithmic trading systems. Modern traders benefit from Dennis's vision, applying his principles with the speed and scale enabled by technology. Educational legacy and democratization. Dennis's experiment underscored the power of education in trading success. By training novices with no prior experience, he showed that skill and mindset outweigh background or pedigree. This principle inspired educational platforms, trading schools, and mentorship programs worldwide. His legacy champions the idea that trading is a craft that can be learned and mastered through effort and discipline. A testament to human potential. Richard Dennis's life is a testament to what human potential can achieve when combined with the right system and mindset. He broke barriers of socioeconomic status and industry norms. His story resonates beyond finance as an example of vision, innovation, and perseverance. Dennis demonstrated that with structure, belief, and discipline, extraordinary results are within reach. Challenges and controversies. A balanced legacy. Like any impactful figure, Dennis's legacy is nuanced. Some critics argue that his methods contributed to market volatility or encouraged excessive speculation. Others question the long-term viability of pure trend following in increasingly complex markets. Nonetheless, his contributions remain foundational, sparking debate and innovation. The future of Dennis's influence. As markets evolve with AI, big data, and decentralized finance, Dennis's core lessons endure. Systems and discipline remain crucial. Adaptability and continuous learning are key. The democratization of trading continues, with technology lowering barriers. Final thought. Richard Dennis's legacy is not frozen in the past. It is a living, evolving influence that challenges every trader to combine rigor, innovation, and humility. His life's work reminds us that in the ever-changing markets, the blend of system and soul creates enduring success. Chapter 10. Summary of the Turtle Trading Strategy. The Turtle Trading System, born from Richard Dennis's visionary experiment, remains one of the most iconic trend-following strategies in trading history. It embodies simplicity, discipline, and robust risk management, elements that every trader should understand deeply. Core components of the Turtle strategy. Trend following. Buy when the market breaks above recent highs, sell or short when it breaks below recent lows. The system captures large market moves by riding strong trends. Breakout entry rules. The turtles use specific breakout periods, typically 20 and 50 days, to identify entry points. This removed subjective guesswork and emotions from decision-making. Position sizing and risk management. The turtles risked only a small percentage of their capital per trade, adjusting position sizes based on market volatility. This controlled losses and protected their trading capital. Stop-loss discipline. Strict stop-loss rules cut losses quickly, preventing small setbacks from becoming portfolio disasters. Pyramiding. Adding to winning positions incrementally, but only under disciplined rules, allowed for maximizing profits during strong trends. Diversification across markets. The strategy applied across various futures markets, reducing exposure to any single asset and smoothing returns. Why it works. Emotion-free rules. Mechanical rules help traders overcome fear and greed. Risk control. Limits drawdowns, preserving capital for future trades. Adaptability. While originally designed for futures, principles apply across markets and instruments. Simplicity. Easy to learn, but powerful in execution. This strategy teaches that trading success is less about predicting the market and more about managing risk and riding proven trends. Conclusion. The path forward. Richard Dennis's story is not just a tale of wealth, but a blueprint for disciplined trading. His legacy challenges every trader, novice or expert, to build systems, manage risk, and approach markets with humility and rigor. The Turtle Trading System, with its timeless principles, offers a powerful framework for navigating financial markets, reminding us that success belongs to those who combine knowledge with unwavering discipline. Join the journey with Trading Books. If you found value in this deep dive into Richard Dennis and the Turtle Trading System, don't miss out on more insights that can transform your trading mindset and skills. Subscribe to the Trading Books channel for weekly content packed with trading strategies, market analysis, and lessons from the world's greatest investors. Hit the notification bell and be part of a community that's serious about mastering the markets.